For the longest time, a big part of crypto's appeal was its anonymity. But that's all changing, especially in South Africa. Today, we're going to break down a huge new global standard that's basically dragging digital assets out of the shadows and putting them right in front of the taxman.
Yeah, it's really the question on everyone's mind, right? For years, the answer was, well, it was murky. That gray area, that feeling of being separate from the old financial world, was a massive draw for so many people. But let me tell you, the ground is shifting right under our feet. The age of crypto anonymity, it's pretty much over.
Okay, so what's really going on here? Well, South Africa has just activated a global framework that is completely rewriting the rules of the game for crypto and taxes. And I want to be super clear about this. This is not just some minor tweak. It's more like they've plugged a brand new operating system into the entire financial grid.
It's got a name, of course, CARF. That stands for the Crypto-Asset Reporting Framework. Now, the most important thing to get here is that this isn't just some local South African thing. Nope, this is a big international standard cooked up by the OECD. The whole point is to create one single, unified system for tax transparency on crypto, and it's happening in dozens of countries. So, CARF, that's the new acronym you've got to get familiar with if you're in the crypto space. So let's break it down. What exactly is it, and how does this whole thing work in practice? Let's dive in.
Okay, the easiest way to think about CARF is like a new rulebook for all the crypto platforms out there. The exchanges, the brokers, the whole shebang. It basically forces them to collect super detailed data on everything their users are doing, every transaction, and then report it all directly to SARS, the South African Revenue Service. The goal here is really simple: make crypto totally visible to the tax authorities. And this is where it gets really interesting. The best analogy for CARF is to think of it as the crypto version of something called CRS, the Common Reporting Standard. Now, you might not have heard of CRS, but for years, banks have been using it to automatically share financial account info between countries. CARF is literally taking that exact same playbook and just applying it to crypto. Same idea, new asset.
So who gets caught in this net? Who's doing all this reporting?
Now, here's the key thing to remember. The responsibility isn't on you, the individual investor. No, the burden falls squarely on the platforms themselves. But even though the service providers, the exchanges, are the ones filing the reports, the impact, well, it ripples out to everybody on this list. Investors and traders, you guys are right at the center of it because it is your transaction data that's now going to be automatically piped over to SARS to be checked against your tax returns. And this flowchart just lays it out perfectly. Look, here's how it works now. You go and make a transaction, buy, sell, whatever. That data doesn't just sit with the exchange anymore. The exchange collects it, they report it to SARS, and then, and this is the big one, SARS can automatically share that info with tax authorities in other countries that are part of the agreement. The data trail just went from local to global.
Okay, so we've got all the technical stuff out of the way. This all leads us to the billion-dollar question, right? What does this actually mean for you? For you as an investor or for any business that's touching crypto?
And here's the thing that's going to make your ears perk up. This is not some idea they're kicking around for the future. This is happening now. The framework officially kicked in on March 1st, 2026. So the new age of crypto reporting, we are already in it. So what's the immediate result of all this? Well, think of it like SARS just got a brand new, super-powered magnifying glass. They can now take the data from the exchanges and put it right alongside your tax return. And believe me, any difference between what you actually traded and what you said you traded is going to light up like a Christmas tree. This table just sums it all up perfectly, doesn't it? The before and after. We have literally gone from a world that was murky, opaque, hard to track, to a brand new reality of systematic, totally transparent global monitoring. That little gray area where crypto used to live when it came to compliance, yeah, that's gone. Poof. And look, it is so important to remember, South Africa is not doing this in a vacuum. They aren't going rogue. This is all part of a huge, coordinated global push to finally drag digital assets into the formal financial system, for good. I mean, think about the problem regulators were facing. On one hand, you've got this borderless asset, right? Crypto can zip around the world in seconds, no banks involved. So what was their solution? Well, they decided to create a borderless reporting system to match it, a global grid to track a global asset. It actually makes perfect sense when you think about it. And this quote right here from the analysis just nails it. It really captures the entire shift in one sentence. It's basically the headline for this new chapter in crypto's story. The whole idea of crypto operating in some kind of regulatory shadow, that's officially over.
So this all leaves us with one final and I think really important question to chew on. As crypto gets pulled deeper and deeper into the regulated global financial system, what happens to its original promise? The whole decentralization thing. Can something be both regulated and revolutionary at the same time? That's the big tension, the big puzzle the entire industry has to figure out now.